Hello class, in this video we're gonna go over the last chapter of our course, chapter 9, forecasting exchange rates. And again, we will not have homework for chapter 8 and chapter 9, the last two chapters, and they're not gonna be the focus of our final exam either. Okay, chapter objectives. In chapter 9, we're going to try to explain how firms can benefit from forecasting exchange rates, why we are forecasting them, describe the common techniques we use to forecast exchange rates, and explain how forecasting performance can be evaluated and how interval forecasts can be applied. Okay, so let's start with why we are forecasting exchange rates, why the firms need to forecast exchange rates. There are 5 different reasons in total. The first one is that it helps the firm to make hedging decisions. Whether firm hedges may be determined by its forecast of foreign currency values. Number 2, short-term investment decisions. Corporations sometimes have a substantial amount of excess cash available for a short time period. Large deposits can be established in several currencies. Number 3, capital budgeting decisions. When a multinational corporation's parent assesses whether to invest funds in a foreign project, the firm takes into account that the project may periodically require the exchange of currencies. Okay, so when the firm decides whether it needs to hedge, what kind of short-term investment it should make, and whether it should invest in the foreign projects, the firm needs to forecast exchange rates. Also, number 4, earnings assessment. The parent's decision about whether foreign subsidiaries should reinvest earnings in a foreign country or remit earnings back to the parent may be influenced by exchange rate forecasts. Okay, how to manage the earnings that the firm earned in a foreign country also needs forecasting exchange rates. Number 5, long-term financing decisions. MNCs that issue bonds to secure long-term funds may consider denominating the bonds in foreign currencies. Okay, issuing bonds in foreign countries also needs consideration in the forecast of exchange rates. Okay, so when the firm needs to hedge to do short-term investment, consider foreign projects, manage foreign earnings, financing in the foreign country, they need to forecast exchange rates. All right, so this graph shows the corporate motivations for forecasting exchange rates. Okay, it includes decide whether to hedge foreign currency cash flows, decide whether to invest in foreign projects, decide whether foreign subsidiaries should remit earnings. Okay, for these 3, motivations, the firm would like to have higher dollar cash flow, so the firm value could be higher. And when the firm is trying to decide whether to obtain financing in foreign countries, the firm would like to have a lower cost of capital, so the firm value would be higher. We have 3 techniques here: technical, fundamental, and market-based. Okay, for the first technical forecasting, it involves the use of historical exchange rate to predict future values. Okay, it's similar to how we use the past stock prices to estimate beta and predict future stock price, right? Here we're using historical data on exchange rate to predict the future ones. There are limitations though. It focuses on the near future. It rarely provides point estimates or range of possible future values. The technical forecasting model that worked well in one period may not work well in another. We also have fundamental forecasting technique. It's based on fundamental relationships between economic variables and exchange rates. We use sensitivity analysis to consider more than one possible outcome for the factor exhibiting uncertainty. Use of PPP. While the inflation differential by itself is not sufficient to accurately forecast exchange rate movements, it should be included in any fundamental forecasting model. Limitations of fundamental forecasting include unknown timing of the impact of some factors. Forecasts of some factors may be difficult to obtain. Some factors are not easily quantified. Regression coefficients may not remain constant. Okay, so instead of using historical data on exchange rates, we're using the predicted economic variables, economic factors, okay, including inflation according to purchasing power parity, okay, and some other factors to predict the future exchange rates. The third method is market-based forecasting. We use the spot rate to forecast the future spot rate. We use the forward rate to forecast the future spot rate. Okay, so the expected exchange rate equals to P and also equal to the forward rate divided by spot rate minus 1. Okay, EE, expected exchange rate, stands for the expected percentage change in the exchange rate. P is the percentage by which the forward rate exceeds the spot rate. Okay, it is also, this equation can also be equal to forward minus S divided by S. The forward rate should serve as a reasonable forecast for the future spot rate because other speculators would trade forward contracts or future contracts to capitalize on the difference between the forward rate and the expected future spot rate. Long-term forecasting with forward rates. Long-term exchange rate forecasts can be derived from long-term forward rates. Like any method of forecasting exchange rates, the forward rate is typically more accurate when forecasting exchange rates for short-term horizons than long-term horizons. Implications of the IFE, International Fisher Effect, for forecasts. Since the forward rate captures the interest rate differential, and therefore the expected inflation rate differential between two countries, it should provide more accurate forecasts for currencies in high inflation countries than the spot rate. Mixed forecasting. Use of a combination of forecasting techniques. Mixed forecast is then a weighted average of the various forecasts developed. Guidelines for implementing a forecast. All managers of an MNC should rely on the same exchange rate forecasts. MNCs may complement their forecast by hiring forecasting services to obtain exchange rate forecasts. Example, forecasts of Mexican peso drawn from each forecasting techniques. So we have technical, fundamental, and market-based forecasts here. The factors to be considered in technical forecast is the recent movement in peso. The situation is that the peso's value declined below a specific threshold level in the last few weeks. The forecast is that the peso's value will continue to fall now that it is beyond the threshold level. Fundamental forecast considers economic growth, inflation, and interest rates. Mexico's interest rates are high and inflation should remain low. So the peso's value will rise as U.S. investors capitalize on the high interest rates by investing in Mexican securities. The spot rate and forward rate are the factors to consider in the market-based forecast. The peso's forward rate exhibits a significant discount, which is attributed to Mexico's relatively high interest rates. Based on the forward rate, which provides a forecast of the future spot rate, peso's value will decline. Forecast error. Measure forecast error. absolute forecast error is a percentage of the realized value equals to the forecasted value minus the realized value divided by the realized value. Okay, this is how we calculate absolute forecast error. Among time horizons, the potential forecast error for a particular currency depends on the forecast horizon. Over time periods, the forecast error for a given currency changes over time. Among currencies, the ability to forecast currency values may vary with the currency of concern. Forecast bias. When the forecast error is measured as the forecasted value minus the realized value, negative errors indicate underestimating, while positive estimates indicating overestimating. Okay, and this is consistent with this formula here too. When forecasted value is higher than the realized value, we have a positive error here, and it's overestimating. When forecasted value is lower than realized value, the error here is negative, and it's underestimating. Okay, this is the absolute forecast error as percentage of realized value for the British pound over time. Okay, you can see it varies over time. How the forecast error is influenced by volatility. Okay, you can see it's when the volatility is higher, the forecast error is also higher. Statistical test of forecast bias. A conventional method of testing for forecast bias is to apply the following regression model to historical data, where ST is spot rate at time t, ft minus 1 is forward rate at time t minus 1, mu t is error term, alpha 0 is intercept, alpha 1 is regression coefficient. Forecast bias can be examined with the use of a graph that compares forecasted values with the realized values of various time periods. Shifts in forecast bias over time. Because the forecast bias can change over time, refining a forecast to adjust for forecast bias detected in the past is not a perfect solution. Okay, so over time here, we have predict value of currency Q for end of period and realized value of currency Q as of end of period. Okay, so we can use the predict value minus the realized value divided by realized value to calculate the forecast error. Okay, and we can draw a vertical line here. And for the points below the line is the region of upward bias, where the area, the region above the line is downward bias area. Comparison of forecasting methods. An MNC can compare forecasting methods by plotting the points relating to the two methods on the graph. The performance of the two methods can be evaluated by comparing distances of points from the 45-degree line. In some cases, neither forecasting method can stand out as superior when compared graphically. Comparisons of forecast techniques. Again, we have different time periods. We have predicted value of zloty by model 1 and model 2, and realized value of zloty, or this currency. And then we have absolute forecast error using model 1. And then we have absolute forecast error using model 2. And the difference in absolute forecast error between model 1 and model 2. Okay, we use model 1 absolute forecast error minus model 2 absolute forecast error. Forecasting under market efficiency, weak form efficiency, historical and current exchange rate information is already reflected in today's exchange rate and is not useful for forecasting. Semi-strong form efficiency, all relevant public information is already reflected in today's exchange rate. Strong form efficiency, all relevant public and private information is already reflected in today's exchange rate. Methods of forecasting exchange rate volatility. Use of recent volatility level. The volatility of historical exchange rate movements over a recent period can be used to forecast the future. Use of historical pattern volatilities. If there is a pattern to the exchanges in exchange rate volatility over time, a series of time periods may be used to forecast volatility in the next period. Implied standard deviation. Derive the exchange rate's implied standard deviation from the currency option pricing model. Okay, so these are something you could know a little bit about, and if you are interested, you can dig further on the option pricing model. Summary. Multinational corporations need exchange rate forecasts to make decisions on hedging payables, receivables, short-term financing investment, capital budgeting, and long-term financing. The most common forecasting techniques can be classified as technical, fundamental, market-based, and mixed. Each technique has limitations, and the quality of the forecast produced varies. Yet, due to the high variability in exchange rates, each technique has limited accuracy. Forecasting methods can be evaluated by comparing the actual values of currencies to the values predicted by the forecasting method. To be meaningful, these comparisons should be conducted over several periods. Two criteria used to evaluate performance of forecast method are bias and accuracy. When comparing the accuracy of forecasts for two currencies, the absolute forecast error should be divided by the realized value of the currency to control for differences in the relative values of currencies. Okay, so this is chapter 9, and we will discuss, we will go over the homework questions for chapter 5, 6, and after the first midterm, which are 5, 6, and 7, the 3 chapters, in the next video, and that's gonna be our review for the final exam. All right, I'll see you in the next video.